Welcome to our CFP exam prep discussion on tax deduction clustering, a strategic approach that's frequently tested but often misunderstood by candidates. Let's break down deduction clustering fundamentally. It's a tax planning strategy where taxpayers concentrate or bunch their itemized deductions into specific tax years to maximize their total deductions over multiple years. The core concept involves alternating between taking the standard deduction in some years and itemizing deductions in others. Here's why this matters. Since the Tax Cuts and Jobs Act of 2017, the standard deduction has nearly doubled, making it harder for many taxpayers to benefit from itemizing. The 2023 standard deduction is $13,850 for single filers and $27,700 for married filing jointly. This creates an opportunity for strategic planning. A practical example will help illustrate this. Consider a married couple with annual mortgage interest of $8,000, state and local taxes at the $10,000 limit, and typically $5,000 in charitable contributions. Their total itemized deductions would be $23,000, which is less than the standard deduction of $27,700. In this scenario, taking the standard deduction seems better. However, with deduction clustering, they could double up their charitable contributions to $10,000 in 1 year, pushing their itemized deductions to $28,000, exceeding the standard deduction. The following year, they make no charitable contributions and take the standard deduction. Over 2 years, this strategy yields total deductions of $55,700 instead of $54,400. When studying for the CFP exam, candidates often make several crucial mistakes regarding deduction clustering. The first common error is failing to recognize that certain deductions can't be clustered effectively. State and local tax deductions are capped at $10,000, so clustering these won't help. Another mistake is not considering the time value of money in their calculations. The exam might present scenarios where you need to identify which deductions are most suitable for clustering. Medical expenses, charitable contributions, and property taxes are typically the best candidates. However, mortgage interest payments follow a fixed schedule and usually can't be clustered effectively. A critical concept that exam takers must understand is the interplay between clustering and alternative minimum tax considerations. The AMT can potentially offset the benefits of clustering, and the exam often includes questions testing this relationship. For implementation, taxpayers commonly use donor-advised funds for charitable contribution clustering. This allows them to make a large charitable contribution in 1 year, take the tax deduction immediately, and distribute the actual charitable gifts over several years. The exam frequently tests understanding of donor-advised funds in the context of deduction clustering. The strategy also has important implications for cash flow planning. Clients need sufficient liquidity in clustering years to make larger payments, while maintaining their lifestyle in non-clustering years. The exam may present questions about coordinating this strategy with other financial planning objectives. Remember that deduction clustering isn't suitable for every client. Factors like income level, deduction types, and overall financial goals determine its effectiveness. The exam often requires you to evaluate whether clustering makes sense in specific client scenarios. Understanding deduction clustering isn't just about knowing the mechanics. It's about recognizing when and how to apply it effectively in various client situations while considering the broader tax and financial planning implications.